All right, it looks like we have a critical mass, so we'll go ahead and kick things off. Welcome everyone to today's webinar titled Financing Clean Energy in Affordable Housing Through Green Banks. Today we'll be looking at the Connecticut Green Bank approaches. My name is Bettina Burgu. I'm with the Center for Market Innovation at the Natural Resources Defense Council, which is a U.S.-based but internationally acting environmental organization. And along with our partners at the Coalition for Green Capital, we coordinate the Green Bank Network, which is the host of this webinar. Just a bit about the Green Bank Network. It was founded last year with the aim of increasing knowledge exchange amongst its Green Bank founding members, which includes the Connecticut Green Bank, as well as with other actors in the green finance sector. It does have a website where you can check out our knowledge center that has green banking resources, and we also have a periodic newsletter that you can subscribe to, and our website is on your screen there, and you can also follow us on Twitter at Green Bank Network. So today on this webinar, we're going to hear from Connecticut Green Bank experts on why, since its inception in 2011, it's gotten increasingly involved in providing education, financing, technical assistance, and other resources that address barriers to deployment of clean energy projects in affordable housing properties. And it's very timely because in March, the Connecticut Green Bank welcomed Betsy Crum, a veteran professional in affordable housing development and finance, and generally everything having to do with affordable housing to their board of directors. So now is definitely the right time to hear from Connecticut Green Bank at the staff and the board level about what they're doing and what they're thinking about for the future. So we have three exciting presenters today. They are Carrie O'Neill. She's the Vice President of Residential Programs at Connecticut Green Bank. We have Kim Stevenson, the Associate Director for Multifamily Housing at Connecticut Green Bank. And as I mentioned, we have Betsy Crum, who is Executive Director of the Women's Institute for Housing and Economic Development, WIHED, in Connecticut, and is also a newly appointed member of the Connecticut Green Bank Board of Directors. I did want to mention that unfortunately Betsy has developed a sinus infection and has bronchitis, so she is going to try to speak as loudly as possible, but maybe just not so much, and we're just so happy that she's still willing to be on with us to give her really unique perspective. So finally, I wanted to just mention a couple housekeeping things. Please do submit your written questions throughout the webinar by typing your questions into the little question box that we have on the screen there. We are going to pause midway through the presentation and take a couple questions that have come in already, and then we'll have another longer question and answer at the end. We are going to be recording this webinar, so that recording will be posted on the Green Bank Network website, as well as on the Connecticut Green Bank website, and on the Green Bank Network website you can also see our past webinars. So I'm now going to hand it off to Carrie. Thank you, Carrie.
Thank you, Bettina. And throughout, myself and Kim will be asking Betsy to weigh in on the presentation. And I just want to thank NRDC and the Green Bank Network for inviting us to talk about our approaches to the affordable housing market and how we can deploy more clean energy in affordable housing. It's a very challenging market, but a very gratifying market, and I don't think we have all the answers, but we're happy to share where we are so far and what we've learned to date. So if you want to go to the next slide. Just a little bit of background on the Connecticut Green Bank. We are the nation's first green bank, and we have currently a balance sheet of about $120 million in assets. As Bettina mentioned, we were formed in 2011, and we just crossed about the billion, a couple months ago, the $1 billion in investment in Connecticut's clean energy economy milestone, which is a big milestone for us. We're very proud of that. And one of the things that we're very proud of is through the culmination of the board supporting our work in low to moderate income efforts for 3 or 4 years, just last year, the board adopted a fourth organizational goal, which you see here on the slide, to support affordable and healthy homes and businesses in distressed communities and reducing the energy burdens for businesses and homes in those communities. And our low-income board member throughout that time, Pat Rice, really educated us about energy burdens and the challenge of our most vulnerable citizens around energy burdens. And when she retired and Betsy Crum joined the board, Kim and I were so delighted to have this advancement in our board, to now have someone so steeped in affordable housing and the issues facing affordable housing. So I just wanted to pause there and give Betsy maybe an opportunity to comment on the Green Bank and joining the board.
Sure. Welcome, everyone, and I'm glad to be here. And my first introduction to the Green Bank was in my previous job, where I was the executive director of the Connecticut Housing Coalition. And in that role, I think I felt it was my job as a former developer and an advocate for affordable housing, and someone who'd worked in the finance world, to kind of try to play the role of translator or intermediary bridge among all those entities. And we really hadn't done, frankly, a very good job in Connecticut in terms of bringing green technology and energy improvements into our various housing programs, and we're one of the few states in the country that has state-financed public housing, and we've done a terrible job, actually, of bringing green technology into that. Most of our public housing was developed during the 70s and 80s and had a lot of old electric heating and all kinds of, messy, inefficient technologies. So it was a great opportunity when I came to know the Green Bank, to see if there was a way we could get their financing more into our development deals. It seemed a little insurmountable, but I think you'll hear as we go forward how we kind of cracked that nut.
Thanks, Betsy.
Sure.
Next slide. So I thought we'd start really high level with a case study to ground us in what we think of as the opportunity when we think about energy upgrades in multifamily, affordable multifamily. This is, if you have an opportunity, click on the link. There's a wonderful video that does a much better job telling the story than I can do. It's really a wonderful, wonderful story. This is an affordable housing condo association that serves residents that are at 60% of area median income or lower, of 82 units. They had gone to numerous financial institutions and had been turned down, and came to us and our CDFI partner, Capital for Change. This is really a story of where the energy savings can unlock not only the ability to pay for energy upgrades, but other things as well. This property needed a new roof, it needed lighting, it needed boilers and insulation, and with a combination of utility incentives, which, by the way, weren't even as rich as we see as in many, many other deals, and the financing, the estimated annual savings for the energy were so strong that they more than covered the debt service and allowed much more to be financed, including these necessary repairs around the roof and lighting and so health and safety. And one of the great stories that came out of this was that the overall improvements actually bumped them into a better insurance category, something we hadn't even thought about as an additional benefit that could come out of these sorts of things. So we just wanted to ground folks in sort of the opportunity right away. And Betsy, you have a great way of characterizing these sorts of deals.
Yeah, so when I heard about this scenario, as a developer, I was just like, oh my God, this is found money. If I'm a property manager and I'm trying to juggle the million things that need to be done with my annual operating income, things like a roof, new boilers, and that sort of thing can almost really never get done. You have to borrow for it or find some way to get a grant. Affordable housing doesn't really have the ability to typically to go and raise the rent to cover the improvements that are needed, and it operates on a very slim margin. So when I saw this, this is underwriting based on the estimated annual savings from the utility improvements that, in addition to doing the utilities, which probably would not have been my #1 priority as a property owner, it lets me do my roof replacement, which would have been my #1 priority as a property owner. And so the aha moment I had on this was that this was found money for my project. It was not just the energy improvements, but generated enough capital through this loan that I was able to do everything I needed to have done in my property. So this is like new money, found money.
So you see why we love that Betsy's now joined our board, because she's given us a whole new language.
I found money.
in describing our work. Next slide, please. So again, at a very, very high level, I just wanted to ground folks in terms of what we've done so far, and then we'll talk about how we look at the market and how we did it. We have a benchmarking program that has benchmarked almost 1,100 buildings, more than 19,000 units. We have a pre-development loan program that has closed 24 loans so far, and then we've got various term loan financing available. But you'll hear later where this is really not our focus and what we've done so far. All told, this covers on the pre-dev and term side about 3,800 units. Next slide. Just in terms of how we look at the market first, and you could click forward once more, Bettina, just in terms of how we look at the market in terms of income, we just lost our screen here. Let's see if I can get it back. In terms of income, we look at AMI, area median income bands. I'm sorry, one second. Let's see if I can get my screen back. We look at area median income bands, and in terms of our definitions, we're looking at, we defined low income as 80% of area median income or lower, and we're looking at moderate income as 81 to 100% of area median income or lower. So these are important. Every organization has different definitions. This is what the Green Bank chose in terms of discussing with lots of different folks. And when we set our income limits, we also set them in coordination with the Department of Housing and the State Housing Finance Authority. And they are basing their income limits off the HUD limits. So we very intentionally aligned ourselves with the housing world for income limits as opposed to the energy world, because we felt it was important to be able to integrate ourselves into the affordable housing capital stacks and programs. And we also look at, we've done a lot of data visualization about where our low-income residents live and things of that nature. If you go to the next slide, and in terms of just looking at the multifamily housing stock, and we've charted out, you know, whether it's the 5 to 9s, 10 to 19s, 20 to 49s, et cetera, you know, what part of the market or how much of the market each characterized. About half of the multifamily units serve low-income households. About 90,000 of these units are assisted or rent-restricted units. The remainder are naturally occurring affordable housing units. Our Housing Finance Authority finances about 40,000 of these units. The remainder have assistance from Department of Housing or HUD. A big chunk of our larger multifamily buildings are concentrated in about 30 or 40 municipalities, but really about 50% or half are in 5 core cities where many of these have a high concentration of HUD properties. So we've really done a lot of studying on where and the nature of these sorts of properties. Next slide. And then just last, wrapping up, and then Betsy, I'll ask you to comment overall on the market. Wow, our housing stock is not just about energy. Many other issues, a lot of health and safety issues, whether it's knob and tube wiring or, you know, mold and water leak, asbestos, lead paint, you know, other things of that nature. We have decades of deferred maintenance that are at play here. And especially with our smaller multifamily properties, you know, we see owners are stretched and strapped and challenged to deal with these issues because they are so complex. Our larger properties are dealing with this too, but they tend to have a little bit more sophistication and capability for contending with this, and if they can find the financing. But let me just stop there. That was a lot to go through in terms of how we think of the market. Betsy, any comments?
Yeah, I'll just add a couple thoughts. I think in the previous slide you kind of laid out very clearly where the size falls out, and I think it follows generally that about half of, I'd say about half of the affordable, what we would consider affordable to the people below 80% AMI range in Connecticut, about half of it is publicly financed in one way or another, either through HUD or our State Department of Housing or Connecticut Housing Finance Authority, or in some combination of that financing. And so I think we saw that as a good logical hook because to reach folks because of our relationships, or my relationships when I started working with the Green Bank with those agencies, and of course they have developed those relationships. The other, the sort of natural, what we think of as naturally occurring, are the mom and pop kind of operation. Connecticut is an older city in the United States, so we have a lot of housing stock that was built even in the in the 19th and early 20th century, and especially in our core inner cities. Affordability is difficult in Connecticut too, just in terms of the market, because we have a shortage of, the National Low Income Housing Coalition has looked at the housing need in the state, and we fall short by some estimates of about 80,000 units in order to get the supply and demand really to work well in Connecticut. So while we have an aging housing stock, it's still in very high demand, and so affordability is challenging. So I think, again, the more that we look, and Carrie mentioned looking at the capital stack and trying to keep the financing such that it can work in affordable housing, is very challenging, because these properties tend to not generate a lot of income because the rents, the ability of the tenants to pay is very limited. So it gets into a whole new sphere, I think, from what the Green Bank's traditional lending has been.
That's absolutely true. Next slide. Just moving on to how we think about energy burdens. We do think about energy burdens a lot when we're designing programs. Operation Fuel in the state does an energy affordability gap study every year, and it has in the last couple of years swung quite a bit with the price of oil and gas. But suffice it to say, even when the price of oil and gas has gone down a lot, the gap is still significant. And this gap is basically the gap of, what energy costs are for low-income households above what's considered an acceptable energy burden of 6% of income. If you go to the next slide, the Department of Energy has provided a handful of states in the Low-Income Clean Energy Accelerator, a really interesting tool. So I've just shown you around the dotted line for renters at different area median income bands. The blue bars give you a sense of the dollars that are being spent on average for households for energy, and it's quite interesting. The dollars don't move that much. It's pretty consistent, but the incomes, and the orange bars give you a percent of energy burden, but the incomes are very different, and I provided on the lower right-hand corner how drastically different the incomes are in a state like Connecticut that's pretty unequal. And so the energy burden is very, very significant for our lower income residents, and this is really where we're trying to move the needle. Next slide. Before I turn it over to Kim, I just wanted to leave you with two additional case studies to kind of ground your thinking as Kim starts to go into the approaches. When we think about unlocking cash flows, it's not only to do these energy upgrades and unlock cash flow to do additional improvements, but it's also to stabilize properties and make sure that these properties don't, fall into such financial ruin that they end up being bought out by a developer and they become market rate. So it's a preservation of affordable housing as well. These are examples of co-ops that are very in development, meaning we've been working with them for a long time, trying to get them into pre-development before we even get them into project development. They're seeing exorbitant energy costs, and these energy costs are literally putting these properties in the red, perilously close to financial ruin, if not kind of already there. And yet, the energy savings, if financed through these strategies that we're talking about, can unlock the cash flows to not only pay for the upgrades for the energy work, get the utilities incentives in there to pay for additional health and safety upgrades that are needed, but they can also put these properties in the black. And that's what we're trying to do. So with that,
Carrie, let me just add quickly to that as part of the market. New Haven and Bridgeport are two of our oldest cities, and two of the areas that have historically had the biggest concentrations of low-income residents. They are also currently two of the hottest cities in terms of market. They're both on the rail line to New York City and there are huge pressures. And so these two cooperatives, which are resident-run affordable housing, kind of in an older model, really are at risk of being lost to the market. And so I think it's important, and to those who care about affordable housing, to think about these two that were built so long ago being really at risk of being lost as affordable housing as much because of their energy costs as any other reason. So it really does become a huge preservation tool.
Great. Well, Tina,
yeah, go ahead.
Yeah, I was going to just jump in here, and we have a question that's come in. Thanks especially for grounding us in the case studies and the statistics. This is a complicated issue. So the question is we have a huge variety of people on the line today, including maybe people who are working for local governments that are thinking about launching their own green finance institution or green bank. So for those green banks that might be just starting out, what would be the important steps to start engaging with the affordable housing sector, and especially affordable housing lenders, to get a multifamily housing program underway?
So I feel like we should maybe hold that thought until we have Kim go through and see if we should still if they still want to have that question answered after we have Kim go through the partnership development. Is that too much of a punt?
Absolutely, no, that's fine. We can definitely do that. And actually, the questions that we have are getting a little bit more specific about program development and underwriting and such. So why don't we just continue on then, and then we can save the time for a longer Q&A and really get into the details.
Okay, great. So next slide. We're gonna have Kim Stevenson go next.
Yeah, hi, good afternoon, everyone. Really excited about sharing this information with you all. And what I'm going to do is I'm going to talk about kind of the history of our program development and our partnerships, how that evolved, and then we'll talk a little bit more about some of the programmatic details. So this slide right here is I'm going to walk you through a timeline of kind of the events that occurred in getting to where we are today. In the beginning, back in 2012, 2013, when we started this work, we saw significant opportunity in the multifamily market, for really for releasing the cash savings and this found money that Betsy was talking about. But we were just not getting much headway in terms of getting interest from owners or closing deals. It's a tough market, as many of you know. So we began by approaching the sector by surveying the market to identify structural challenges impeding progress, as well as identifying who were the key players in this market in Connecticut, who were the thought leaders, and where were the centers of excellence in terms of driving housing work, not just energy work, but housing work in Connecticut, and where are the low-hanging fruit and opportunities. What we identified as the big challenges were that the energy improvement process was just too complex for owners to navigate, especially if they're trying to take a holistic approach that looks at multiple measures and goes deeper and looks at the property over its lifetime. Many owners of affordable housing in Connecticut, while they deserve angel halos. They're spread thin. They've got many competing priorities. So it's not something they can take on easily. And also they've been burned many times, so they don't know who to trust. And others are not motivated to invest in energy improvements if the tenants are paying the utility bills, as it's the tenants that benefit from the energy savings, or at least it's perceived that the tenants benefit from the energy savings and not the owners. So the big opportunities that we saw were in master metered properties, and that means properties where the owner pays the utility bills. And if improvements are made, then the owner can directly take advantage of the cost savings. Properties where there's potential system failure and the need for system replacement, properties that have crushing energy bills, and another sort of big area of opportunity is where you've got motivated owners that are really trying to do the right thing and want to do this work. So go ahead and to the next one. Another big challenge and opportunity area was with the state-sponsored housing portfolio that I think Betsy referred to this a little bit earlier. Back in the early days, we had a new governor who had come on board. Governor Malloy had allocated $300 million or $30 million a year over 10 years for badly needed capital improvements to the state-supported housing. Capital needs assessments were done on all of these properties, but only a few looked at energy. And we kind of looked at that and said, boy, there was a huge missing opportunity here. And there wasn't a clear process for getting energy work done early in the design process, or energy assessments and energy work looked at early in the design process. And what was happening was that utility incentives weren't getting included in the capital stack for financing these projects. And when the projects were getting funded, ultimately what was happening was that the upfront costs of the energy improvements were getting cost engineered out rather than value engineered in. And this was sort of a big area that we really approached in terms of a challenge to address, but in partnership. The Connecticut Green Bank, the Connecticut Housing Finance Agency, the utility companies, and the Department of Housing began talking to each other through regular interagency meetings. You can move on to the next one. And you can move to the next one as well. Yep. And we really began to make headway on this challenge when we worked through a lean process. This was an analysis. It was actually funded by our Department of Energy and Environmental Protection. They helped pull all the agencies together dealing with housing. And this was a process whereby we looked at what is the process? What are the inefficiencies in the process? What's working? What's not? And what does an ideal final result look like? And this process included all of our housing agencies and other key stakeholders. The core team worked together for a week. It was probably 50 hours together, 10 hours a day, where we really, really hashed all of this out. And what ultimately resulted in this was an expedited process for doing an upfront energy analysis and committing utility incentives into the capital stack through what became a letter of participation by the utility companies. And as a result of all this work, now every project in the state that receives funding from the Department of Housing or CHAFA has to go through this energy analysis process, and utility incentives are included in the capital stack. So it was really sort of an important piece of work. And going back in time a little bit, back in 2014, the Green Bank and the Housing Finance Authority also partnered on a demonstration program whereby the Housing Authority selected 5 state-funded properties to take through an energy improvement process that included benchmarking, assessments, audits, design, and then funding. I think CHAFA really wanted to ultimately understand and get comfortable with energy underwriting. The Green Bank needed projects just to get our hands dirty with, because we were in the early days of program development, to understand the market and the challenges. These properties represented a cross-section of municipal housing authorities and privately owned properties. And this demonstration program was the place where we all learned by doing, and we got our hand. It's like wind forward 4 years later. The 5th property, we're just about to close on it in the next couple of weeks. It's sort of been a challenging process. It was painful at times, but we learned by doing, and this informed all of our current program development and the programs that we have that we're offering to the market right now. Then in 2014, we also began conversations with the Housing Coalition, where Betsy Crum was the director at the time, to explore Housing Coalition support for helping to reach out and educate the market. Betsy was certainly thinking about things much more strategically than I was, I think, at the time. We basically saw the coalition as having 2 things. One was the best Rolodex in the state to reach out to the market, and the respect and trust of the key stakeholders. And with the Green Bank really being the new kid on the block, we had none of this. So we were thrilled to partner with the Housing Coalition. And then what began as a contract with the Housing Coalition to coordinate and support outreach throughout the state evolved into trainings on best practices in partnership with both the Department of Housing and the Housing Finance Agency. And then this year we established a peer-to-peer network of real sort of leading thought leaders and practitioners in the state. Go ahead, you can advance. The conversations resulting from these trainings, I think, ultimately led CHAFA and Department of Housing to adding points to the scoring system for the qualified application plan, and this is the highly coveted 9% tax credits. And, you know, really great leadership on the part of CHAFA and also Department of Housing in making this happen. And I think it's already shifting the subsidized affordable housing market in Connecticut to greener buildings.
Can I just add a comment, Carrie?
Go ahead, yeah.
Right there, or Kim. As I mentioned earlier, the sort of aha moment for existing property owners is when you can generate a source of funds to take care of all their problems, not just energy problems. For developers of new housing or doing substantial rehab, the big golden key here was creating points in the competitive application rounds. So for those of you who are thinking about, you know, how to get that wedge in your local in your local world, create the holy grail in a way, I think, is to create incentives to do it not through so much through post-construction incentives, but to monetize those incentives, which Kim mentioned they did it through this pilot, and to put points in the rating and ranking system because developers will chase the points, period, end of the story. So those were two really key things that made a difference. I'm done.
Okay, yeah. Thanks, Betsy. So kind of in parallel and threaded through all this work, Capital for Change, which is the Hartford-based community development finance institution, launched the low-income multifamily energy loan program. And a real key element of this program is that it does energy underwriting on projected energy savings, but these are also unsecured loans. The Green Bank provides a loan loss reserve. We help to capitalize this, and this has really seen really big success in Connecticut with great leadership at Capital for Change. New Ecology, a nonprofit focused on green and sustainable building, also entered Connecticut in 2013, 2014, funded by the JPB Foundation. Our work with New Ecology, funded by JPB, resulted in a partnership and design of our pre-development loan programs. The JPB dollars also funded an initial round of energy performance benchmarking that was done by WeGoWise and has led ultimately to a partnership that we now have with the Housing Finance Agency, where we're trying to benchmark 1,500 buildings in Connecticut. The JPB Foundation has also similarly funded a solar nonprofit, Grid Alternatives, to perform solar feasibility analyses for affordable housing. Go ahead and advance. And then in 2015, the MacArthur Foundation made a $5 million program-related investment in the Green Bank, enabling us to fund all of our pre-development and term loans that cover both energy-related and health and safety measures. And I just want to emphasize here, for the foundation community and for everyone on the call, this foundation funding has been absolutely critical to everything we've done here, including the JPB dollars that didn't come to the Green Bank but supported our partners in helping us do our work and catalyze this market. And then several months ago, we launched the Energize Connecticut Multifamily Initiative. This establishes a more integrated process to working with the utility companies and the utility incentives for funding what we call mid-cycle properties. These are properties that are not at a key financing event. They're somewhere mid-cycle where we need to add debt to them to finance the energy improvements. And also this process encourages a deeper and more holistic approach. And this year we've also received a second program-related investment from the Kresge Foundation for solar and storage. And I'm going to stop there and go ahead and advance to the next slide. So just this slide here, these are our partners. These are all the people that we've worked with and we've built relationships with over the last 6 years. The main point here is that it takes all these partners to make this successful: foundations, agencies, community development finance institutions, the utility partners, and also our outreach partners. Go ahead to the next slide. Yeah, next slide. Okay. This slide here, just very quickly, these are our programs that we offer. We offer both pre-development resources and term financing. You can learn more about these programs at the Green Bank website. On the term financing, the Lime loan is an unsecured loan, as I mentioned previously. We offer solar financing for folks that are looking to do just solar only, off-balance sheet financing, and gap financing for projects that need that extra push. Next slide. Okay. A couple words on this slide right here. This is kind of how we think about the market in very simplistic terms. In terms of housing that serves the low and moderate income sector, you have subsidized rent-restricted housing, and you sort of opposite to that, you have the non-subsidized, non-restricted, but sort of naturally occurring affordable housing. And how those projects are financed in the capital stacks and the restrictions on putting existing debt on those projects tends to be very different, and it's an important consideration. And then along the vertical axis, you have what we refer to as mid-cycle properties. These are properties that are not at a major event in the life of the property. It might be a refinance, a sale, a major capital improvement. They just simply need energy and health and safety improvements that would be funded by utility incentives existing, and then existing debt, and then finally properties below on the axis that are at some kind of major event. It's either new construction, a substantial rehab, a refinance, or a sale advance to this. Yeah. So we've taken a very sort of flexible approach to looking at the market, and if we're not needed, we don't play there. So, for example, in the subsidized world, it's mainly been partnerships and supporting our partners, and we've found in many cases that the Green Bank debt and financing just can't compete with what our housing agency partners can offer, so we don't play there in the capital stacks. You know, alternatively, with many of the mid-cycle properties, they really need unsecured financing. There's existing covenants and debt that make it difficult to add additional debt. So our programs really work well with these types of properties. So as you're looking to do program design, these are some really important considerations. Let's go on to the next slide. Yeah. I'm going to skip this slide. We've talked about a lot of this as well. This slide here, you can all see, this is just sort of summarizes the work and the accomplishments with our partners. And just one point to make here is that with all these programs, we're starting to see subsequent applications and repeat developers, property owners coming back to us after they've had a good first experience with us. Go ahead to the next slide.
So I think this is Terry O'Neill, in wrapping up, well, I think you can all read the parting thoughts. I think our big takeaway, at least for Kim and myself, has always been there's no way for us to go it alone. In a market like this, we really have to figure out who the right partners are and also the right people. It's both the right organizations and the right champions in those organizations, and sometimes it's just individuals who are those connection points. Betsy Crum was clearly one of those. And also on our own team, you know, we have a diverse set of skill sets within the Green Bank who work on this. It's not just Kim and myself, it's finance folks, it's other folks as well. And so while it's hard work, it's, you know, financing is probably the least of it. It's all the other relationship building and listening, really listening as you get to know these other sectors. And, you know, we put the program design at the end, and we talked about it at the end, really by design and intentionally, because that's how we did our programs. We got out there, we tried to understand the market first and then do program design. So Betsy and Kim, I don't know if you have any other final thoughts.
I'll add a couple final thoughts I have coming from my perspective. I think those of us in affordable housing are sort of by nature a little reluctant to get into the green technology, the energy incentives, because they seem like an extra. They seem, I think somebody said earlier, you know, they're not seen as a way to, they're seen as a way, it's something you need to value engineer out instead of in, because of cost and history. And so the first couple times that Kim met with me, I was just like, yeah, you know, and she was very persistent and very kind of interested to find out what the barriers were. And I think, you know, as I learned more about the different players, to me, you know, LegalWise and Green Energies and Connecticut Green Bank and Eversource and Energy, you know, they were just a jumble of names. But I think there was a real role to them educating me and getting sort of past the reluctance that a lot of affordable housing developers have to stepping into something that seems, you know, very much like an extra or a nice thing to have, and seeing it as something that we really needed to have. The other thing I'll just say that they didn't mention is the first money in piece. The pre-development financing, I think, has potential to be very important, and for any developer of affordable housing is super competitive and highly leveraged. Getting that first money in is a critical component, and the fact that the Green Bank is willing to be that first money in, I think, was another real way to kind of grow and cement themselves in our world. I think that's all I have.
Awesome. Well, thank you to Carrie, Kim, and Betsy, to each of you for your insights today. And we do have a lot of questions coming in, so I don't think we'll get to all of them, but I'll certainly forward them on to you along with people's contact information, and hopefully you guys can find time to get back to them if we don't address them. And also, we had a couple questions about whether people can access the slides. And yes, in addition to the recording of this webinar, we will post the slide deck to the Green Bank Network website in the Knowledge Center. So that being said, I think since it was brought up earlier, we'll go back to the earlier question about if you're just starting out, if you're in a jurisdiction, you're looking at launching a green bank, or you have one and you're thinking about launching a multifamily affordable housing program, what would be the first steps, you know, off of your lessons learned that you mentioned to get that started? And someone else asked the question about larger states. You had mentioned that foundation support was critical in Connecticut, so how could that work in states that would need a larger green bank than Connecticut?
Yeah, so let me just do the first one in terms of how do you get started. You know, really, I just dove into it and tried to figure out what's the market, who are the players, what are the challenges, and then who can we partner with to get projects and really kind of advance this market. I mean, that was how we started. And a lot of the initial starting out was also just relationship based. So I was working with a team of consultants that had long-standing relationships in the affordable housing market who were also able to bring deals to the table and were willing to work through everything with us. And just like we actually recognized it was so challenging for owners initially that with that demonstration program I talked about, we actually paid the owners to participate, believe it or not, and spend the time to work with us to help figure it out. So like really thinking differently about, you know, how you're doing this work and what you're asking people to do.
I think the other key thing, this is Carrie, is that, you know, for Department of Housing and CHAFA, and they had a mission of preserving affordable housing, and they had already identified energy costs as a challenge. And so we found points of common interest, and then tried to, you know, build from there. So whether that's your local community development financial institutions or local lenders who are already financing affordable housing but can't do it all, or are seeing deals that are falling out that they can't do, that's another potential way into the market.
The other thing I would add, this is Betsy, if you can't tell by my strained voice by now, that the pilot piece was, I think, a really interesting approach that that the Green Bank took. And I found, at least in our state, and I think it's true in many states, that presenting something as a demonstration or a pilot presents less risk. It kind of gives everyone a little bit of cover. And it's also a great way to build those relationships and find out who the real decision makers are and who your real allies are. And it's been very important in Connecticut. We have a long history. I had a colleague who once referred to creating pilots or talking about new programming as having a dinner party, and she called a pilot program or a demonstration the appetizer. It's sort of a way to get everybody's appetite built for what might come later. That's going to be a bigger thing. So I would suggest that that's a key piece.
And then as to the second question for larger states and the foundation support, so there are two aspects to the foundation support. There are nonprofits and service providers operating in this space who are supported by foundations, and their mission is to expand into other markets. We've identified many that are kind of in our toolbox and toolkit. So approach them. Your state may be a great candidate. Often these folks are looking for, they want strong commitment and strong partners on the ground so that they can be successful. And then in terms of the direct foundation support in terms of program-related investments that we got from MacArthur and from Kresge, those take longer to develop. Those are relationship developments in and of themselves, and those are structured as long-term low-interest loans to the Green Bank, or in the case of MacArthur, it was to the Housing Development Fund in partnership with a Green Bank for particular purposes. So we're happy to chat further about that, and it can be done. It is relationship development also.
Great, thank you for that. And we can, like I said, pass on contact info for folks who have submitted that question. So one, hopefully quicker one, you mentioned mid-cycle projects. For those mid-cycle projects, how are energy or loans for energy improvements repaid? Maybe that's to you, Kim.
Say that, how are loans
repaid?
They're repaid by savings from the cash flow savings from the upgrades.
But it's not an on-bill, if that was the intention of the question. It's a loan made by a community development finance institution.
Right, and they just make regular loan payments back.
But the underwriting,
it's like a regular mortgage out of operating.
It's not a mortgage. No, it's not.
It's not a mortgage, but like a mortgage, it's repaid out of their operating income.
Right. Right, and importantly, it's actually the Lime loan is unsecured.
That's huge to the owners. Huge.
And it's huge, and I know that I hope the Capital for Change folks are on the line here. We've been lending, they've been lending, on some projects on the order of $1 million of unsecured debt. And it's the only way these projects can get financed.
Great.
Mainly because the other mortgage holders wouldn't allow a secured loan. Yeah.
Right. Right. Great, thank you for that clarification. I think we'll do one more step back and do a closing question here. The question is, well, starting with a statement, one challenge that some folks on the line have heard is that there's a challenge for affordable housing owners to navigate the many different programs with the different incentives and audits and financing options from utilities to housing lenders, et cetera, all of these folks in the space that you've mentioned. How does Connecticut Green Bank help owners navigate that complexity for building owners that just don't have the capacity to wade through that by themselves?
Yeah, so we've been working really hard to develop kind of a one-stop shop or a one-stop mall, as we kind of refer to it, where folks will come to myself or John D'Agostino, who manages our pipeline, and then we'll learn more about the property and the project and then try to direct folks in the right direction. The other thing is that what we've done is with our pre-development loan programs, we've developed what we've called the Sherpa loan program with New Ecology, where New Ecology operates as an owner's agent. And the whole purpose of that program is for an owner to be able to work with a trusted advisor to navigate through all of the steps of the process, from the assessments and audits, and then if they'd like to, New Ecology can also offer services to take them through the implementation process as well. And you can learn more about that on our webpage under the Sherpa program.
Great. Well, I think we are at 2 o'clock, so we will close up there. The last thing I'll mention from our Q&A is that several folks on the line have just said thank you for your leadership on this critical issue, and that it's been really informative. So I just want to echo that and say thank you so much to Betsy Crum, Carrie O'Neill, and Kim Stevenson for joining us and giving the presentation, and also to the audience for all of your questions. As I mentioned, we'll follow up with you if we didn't get to your question. You can see the contact information for Betsy, Carrie, and Kim there on the screen, as well as a contact for the Green Bank Network. As I mentioned, we will be posting the recording of this webinar by tomorrow, and the slides will be on the website as well. So on behalf of the Green Bank Network, I just want to thank you for joining us today and hope you have a great rest of your day.
Thank you.
Thank you.